Ladies and gentlemen, welcome back to Ledgerly's top 5 year-end strategies to roll out before 12/31, which is right around the corner, and obviously during the holidays. So maybe you're not thinking about tax planning. I think you should be. But today we're here to cover, honestly, a commonly overlooked strategy, underrated strategy, talking about shifting income and expenses as we're getting closer to year end. It's a way to legally start, hey, shifting income over into the next tax year, so it becomes a 2026 problem, and maybe accelerating some expenses on the front end and capturing deductions in 2025. When done right, legal, and could still be powerful lever to pull, especially with the days dwindling down in 2025, and you might not have capacity to roll out some maybe higher ticket tax strategies. So before we get to the whiteboard, hello, my name is Andrew D'Amico, partner CPA here at Ledgerly, alongside Mike Abrahamian, also CPA, our other partner, where we're always talking about tax saving strategies, helping clients build better asset protection, and ultimately trying to help them build a long-term wealth plan, that generational family wealth roadmap for them. If you like the sound of those things, please like, comment on this video, subscribe to our channel so you can stay up to date and in the loop whenever we're putting out some more free game for you. Directly right to the whiteboard. It's gonna be an easy diagram for you guys here today. I got a little timeline, depending on when this video goes out. It's about December 15th. Got 15 days before 12/31, right? The end of the tax year, and then, just capturing the next 15 days. So why this? Well, if you're familiar, primarily all of us individual income taxpayers, whoever's filing Form 1040, we're going to be what's called cash basis for the large majority. So when we're talking cash basis, that means between, if I had something that goes back further, January 1st to 12/31st, any monies that shifted that came into your business account that went out of your business account, that will be the activity that's reflected on your tax return. So you have about 15 days left to, hey, let's start dishing out some cash, maybe accelerating expenses, because money's got to move before the end of the year if we want to take that deduction. And on the flip side, if now maybe we don't receive money until the next year, hey, now that's next year's income as opposed to our tax, getting an effect on our tax bill this year. So it's very simple. What do I want to do here? I want to increase my expenses before the end of the year, and I want to delay income. So I want to accelerate this. So I guess do an up arrow, and not really decreasing income, but point being, hey, that's decreasing or not, at least not increasing our 2025 income. That's going to be a 2026 thing. And what can this look like? I mean, you're looking at the end of the year. I know for me personally, I do an inventory at the end of every single year, and I go top to bottom on my financial statements. Number one thing I'm looking at is, hey, first, before we really get into the nitty gritty on this, is do a little provision for yourself or talk with an advisor and get an idea of how much income you have. So, I mean, I'm just going to throw up random numbers, but let's say we have a single individual and they have, let's say, $100,000 in AGI, or, let's just make it simple. We're going to say taxable income. And depending on self-employment tax, investment income tax, as well as various investment capital gains tax, income taxes, let's just say at the end of the day, this individual is going to end up owing $20,000 in tax, and they are in, let's just say, the 22% bracket. All right, let's work with that avatar and see if we can make sense about how this works. So I want to increase my expenses. I want to reduce my 20K tax bill. So some things you can do at your end. Let's buy equipment, right? Me, accounting, pretty low overhead, but I just bought a new computer. Mine was starting to get slow and kind of crap out on me. I'm going to need that computer in the future. Did I absolutely need it? No, but I was going to need to replace it probably sometime in 2026. So that was an easy one that I just pulled up into the end of the year. So office supplies, like equipment, right? Computer, laptop. Maybe if you're in a capital intensive business, you need to buy like big machinery and equipment. You're a landscaper, maybe same deal. You got an old lawnmower. I'm not much of a blue collar guy anymore, unfortunately, but whatever you call those lawnmowers that you hop on, I want to say Tiger. That sounds wrong, but hey, maybe you're going to need one in 2026. Maybe you buy it at the end of the year and capture the deduction, and you supplement that with the reinstated bonus depreciation at 100%. You can get potentially, $10, $20, $30,000 write-off. You can write off that full piece of equipment. So those are things I want to do. Other things to think about are like, hey, do you have various insurance policies? You can actually prepay for the next year. A lot of providers will allow you to do that. And the rule of thumb is if it's not over 12 months, so we'll say less than 12 months, kind of 1 year in advance is the cap, then you can take that entire deduction in the year. So December 20th, I re-up on my new insurance. I lock it in for the next year. It's going to expire 12/20/2026. Pay it all up front. I get the deduction this year. Just a few different ways. Other things, maybe pay vendors early that you have working for you, contractors, various subscriptions. I mean, anything you name it. But at the end of the day, we don't want to go chasing deductions. So I don't want to go out and buy something. Like, a lot of people love talking to us and say, hey, I'm thinking of getting a new car. Well, let's take a step back. Do you need a new car for the business? Or are you just staring down a tax bill and you're like, yeah, I could use a car? Is that going to improve your top line? Is that investment going to be worth it? I don't want to have you go out and buy a $100,000 car just for the write-off if it's not going to help you increase your top. So be careful there. It certainly reduces taxes. Is it the best idea for your business? Maybe not. So always keep that kind of in the back of your mind when you're outlining expenses. Like the laptop, I said for myself, like, I'm going to need it. So I just pushed it up. That's a simple. And then on the flip side, this one might get a little tricky. I mean, you can go into some case law talking about like, hey, when does money become taxable to you, even if you are on cash basis, like if you have control over the money. At the end of the day, bottom line, general rule of thumb is just follow the cash. So if you get a check on the last week of December, why don't we hold off on depositing it into the business account until January 2nd? Let's wait until we're in the new year. It's as simple as that. Or you have people on recurring payments and they normally hit December 31st or the 31st or the last day of the month. Maybe just push that next cycle to January 1st. Now, granted, in the following year, then you're still going to pick up 12 payments, or maybe the next year you pick up 13 payments from recurring customers, but you can kind of gamify it. And that's why it's important to come back to your tax projection. Like, hey, looking forward, am I going to have more income next year or less income? If you're going to have less than in the next year, then maybe it makes sense. Maybe I'll be in a lower tax bracket next year. Let's try and push some monies over into this next year. So hold checks, delay invoicing, very simple. Again, this stuff isn't really rocket science, but hey, when we're coming down at the end of the year and we don't have a lot to play with, this can easily get you a few extra tax dollars saved. If we were to just tie a few numbers to these, let's say you bought equipment for $5,000. Maybe you're like me, you got, $1,000 laptop, you prepaid some insurance for, another $1,000, just right there, we're going to get another $7K in expenses. And then, we'll be conservative on the income front. Maybe we were able to shift successfully, $2,500, let's make it easy round numbers. Say delay $3,000 into the new year. So between these two, you're going to save on your profit and loss $10,000 in this year at a 22% tax rate, which our friend was in. That's going to equate to $2,200 taxes saved. Hey, doesn't seem like much, but if you could substantiate it, and these are all going to be things that are going to benefit your business in the future, then why not go ahead and pull the trigger? This is an easy and absolutely legal way to reduce your tax bill, and there's not a whole lot that goes into it. Again, start with a projection for yourself, outline some things you need, and just push those up. But if you want to get more advanced tax strategy, hey, listen, book might be closed or about to be closed coming up on the end of 2025, but for 2026 and moving forward, get in touch with an advisor, contact us, book a call with us, and we can lay out a roadmap and things that we can start implementing at the beginning of 2026. So we have plenty of time, whether it's oil and gas investments or setting up a solo 401k for your business, even a group 401k, or maybe you're falling into the SEP IRA bucket. All these different strategies, plenty of time if you get the ball rolling early in 2026. That's what our advisory services are all about, being proactive and staying on top of these things so we make sure we're getting the ultimate benefit on both sides of the coin, in the current year, in the today, in the now, as well as making sure we have a plan for the future. So guys, if you like this video, please like, comment any questions, or maybe even share with us what you're spending your money on if it's not a Christmas gift this year. What kind of write-offs are you accelerating? But subscribe to the channel and we'll see you on the next video.